Okay, so I will let everybody introduce themselves. Alon, why don't you start?
Sure. So my name is Alon Hillel Tuck. I'm the co-founder, chief financial officer, and chief technical officer of Rocket Hub. It's interesting because it's actually one of the few industries where a CFO and CTO could be shared by the same individual, right? It doesn't really happen, period, in startups or small businesses. Rocket Hub started in 2009 as a perks and rewards-based crowdfunding platform. We quickly grew to be one of the largest and most recognizable brands out there amongst several others, and we were acquired earlier this year by eFactor Group, so now I have a boss. And it's an interesting change because they call you up and they ask for stuff, and I'm not used to that. I had that previously and I left it for a reason, so now I'm kind of stuck. But it's actually been a great ride, and we're really excited about what we're going to be doing in the future.
Good morning, everyone. I'm Kim Wales. I'm the founder and CEO of Wales Capital and Crowd Bureau. Wales Capital is a management consulting firm primarily focused on helping to get entrepreneurship capital, as well as helping the investors to identify deal flow that hopefully will be sustainable. And then Crowd Bureau is a rating agency, and we're focused on bringing together the traditional financial aspects of rating a company, but also overlaying that with social equity capital. So I'm also the executive committee of CFPA. CFPA is the sister organization of CFPA. And I've been a part of this industry since 2012 alongside Dara, Doug, Sam, and all the others, and it's been an honor to just take part in what's going on. And as Sam said earlier, we're just getting started, so I'm very thankful to be here.
Hi, I'm Sarah Hanks. I'm CEO and co-founder of CrowdCheck. We do due diligence and compliance for early stage online investing, and I personally am a 30-year securities lawyer, and I would describe myself as a smart-ass securities lawyer because I am going to challenge a couple of the statements that were made here already.
Yeah.
Well, I think we got to start there then. So out goes the script. Okay, Sarah, what have we gotten wrong this time?
All right, so I don't know what religion Edgar is, but Edgar, as you probably know, is the filing system of the SEC. Edgar will be asleep on May 14th and 15th, and only when he wakes up at 9:30 on May 16th will we be able to file stuff for Title III. So, yeah, I get the counting, but I think it's Monday.
Okay, so let's not spend too much time on that. No, Sam, no, you're not going there. Okay, Sarah.
Attacking my religion.
Okay.
No, I'm attacking Edgar's religion and Edgar's propensity. Because, I mean, look at, it's 2015, and you've got a filing system at a major government agency that goes to bed at 10 o'clock. I did a Reg A filing a few weeks ago when we pushed the button, and we had pushed the button for a test, and it was 9:55, and we only just got the filing in on time. So it's ridiculous.
Okay, let's put it in perspective. On April 5th, 2012, nobody was projecting either the 14th or the 16th, so we're moving on from that issue. Is there anything else you want to challenge that was incorrect? Are you going to take away my award yet? Okay, obviously we all know each other very well, and we've traveled extensively together, so I don't know if it's just punchy. Okay, Title III, what is it and what isn't it? And why isn't Rocket Hub crowdfunding in my sense, Alon?
In your sense?
Yes, we've talked about that. So some of the people in the audience aren't as familiar with some of this stuff.
Right. So, well, we're not allowed to in the way we would like to, right? So since 2009, we've been doing perks and rewards-based crowdfunding, which to very, very quickly explain, but I suspect everybody's familiar. People are able to raise funds online, and those funds are raised not through an investment, but people are actually contributing those funds in support of a project, and in exchange they may or may not receive various goods or services or other types of endorsements, but there's no return on investment, there's no securities traded. What we have noticed on our end is our users have time and time again asked us, I want to actually invest in this company. And I see those way too often. We have a massive list now that's in the thousands, tens of thousands of users who actually want to create issuances, and investors who want to be considered real investors in the projects we see. But we weren't able to really do it in the fashion that made sense because most of these users were not accredited. They didn't have the income or the net worth that allowed them under current regulation, which is not that current anymore, to actually make these kinds of investments. So Title III was for us an opportunity to allow people to make that investment, but we're a wait and see kind of group. So what we've been doing is we've been steering people the right direction. We've been working with a lot of people in the audience and those on the panel on trying to find a way to make it financially feasible, because what we have realized on our end is if it costs a lot of money, basically paying lawyers, accountants, paying the SEC, whatever it may be, it's simply not going to work on our end. So that's why Rocket Hub is still, we haven't really done anything in Title II, we haven't done anything in Title IV, and we certainly are not doing anything in Title III yet, even though some people already are online. And if you see them, tell someone. It's kind of like, it's like that safety announcement on the subways. Like, if you see something, say something. Like, yeah, I mean, we had conversations with various groups about it, and they get shut down pretty fast, rapidly, I would say. Yep. Painfully so. Yeah. So just be careful. The dates we've been discussing are very, very serious dates, and that's one of the reasons why we're not doing it right now.
Fair enough. So, I mean, old school crowdfunding, which is not securities, whether it's Kickstarter, Indiegogo, or Rocket Hub, is not what we're about to talk about. We're also not going to talk about, but I want to frame conversations quickly for people. We're not talking about Title II or Sam's baby Title IV. Sarah, just describe those quickly.
All right, so Title II, accredited crowdfunding, you can say what you like, where you like, how you like it, providing it is true. But you can only sell to accredited investors. Title IV is SEC reviewed. Do not ever use the word approved, but SEC reviewed crowdfunding, which means that you have to go through an SEC and in some cases a state review process in order to sell to anybody. Again, you can say what you like, but that has to get filed with the SEC, so you want to be careful about what you say and how you say it. But the medium, again, and this is what we're seeing with all of these titles, although content may be restricted in some cases, the medium you can use to communicate is unlimited. You can go on Facebook, you can go on social media, you can skywrite, you can have, my favorite is singing kittens on YouTube. You can totally do animated singing kittens, so long as A, it's true, and B, you comply with the SEC's requirements on content. So it's a brave new world across all of the 2, 3, and 4 titles.
I would argue that singing kittens probably can't be true by its very nature, and that is the type of thing the SEC would be upset about.
They said singing kittens were okay.
Yeah. They did say that.
Only
for Sarah's clients. Okay, so that's Title II and IV, which brings us to why we're here and celebrating Title III. Kim, you want to frame that?
Sure. So Title III opens up a new gateway for all investors of all income levels to have an opportunity to put money into any small, medium enterprise. And so it's a new opportunity for us to get these companies funded. And you can do this online through a registered funding platform. And those funding platforms must register with FINRA. So that is, framing the
up to $1 million
up
subject
to $1 million.
to caps. Okay. Right. So why I love having Alon here is, and Rocket Hub's experience, and what he said about all these people who want to invest potentially in some of the campaigns that have raised money on his site or some of the other donation reward pre-order sites, is the first logical step for Title III is getting some of those opportunities that were successful campaigns funded with either equity or debt. And so would you say there's a large number of the campaigns that were successful on your site that are well profiled for Title III?
Yeah, I mean, it's interesting because this is, I think, a similar room that would recognize the fact that success means different things for different people, right? So the argument made by the mass media and partially the peanut gallery around the Jobs Act is success means large returns. And one of the things we've noticed is a lot of these companies have grown out to become sustainable businesses with interesting potential, but they're not these billion-dollar unicorns. And you're not going to get those in a unique way through Title III or our users or anybody else's users that you're not going to get from the regular world. It's not like there's a magical dimension that's being opened up by the Jobs Act. But what I do believe you're going to have is healthy kinds of participation between investors and issuers into businesses that do have potential to get to a very interesting point in their kind of maturity of the company and provide healthy returns to people that definitely outperform the current interest rates in the market, right? So it's actually, the timing is horrendously great, right? Because '08 happened, there was a collapse, there were issues with people getting regular returns in the market, and a lot of individuals saw this as an opportunity that I don't believe it truly is. You're not going to get like these 15, 20% returns in every investment you make. That's just bonkers. But it did help get political support around this, and a lot of people in the room here are supporting it for those kinds of opportunities. So yeah, we do see a lot of interesting activity on our site, and some of these projects have actually done exceptionally well and have moved into 10 to 15, $20 million revenue streams, and some unfortunately higher than 25. But most of them have not, but they are sustainable businesses.
Before we move on, though, let's drill down a little bit on those companies. Are they, from what you gather, are they more likely to do debt or equity if they do Title III campaigns?
Yeah, so it's really tricky because debt is easier to understand for some people, and then equity is easier to understand for some people. So we've done a lot of surveys, and we have hundreds of thousands of users, and legitimately it's 50-50. I kid you not. They're saying, I want someone to invest in my coffee shop, and I will give them X percentage of my gross profits at the end of the year. I'm like, well, that's a form of debt. You can do that. There's a way to play with that. Some other people say, I'm just going to allow someone to buy a share in my company, and that's it. And it's a very simple share. Maybe it's preferred versus common because of voting right issues, but it's a direct investment, and some people just prefer that as well. And because of that, it's a very down the road, but the one thing I could tell you is it's simple. There are no complex structures. Nobody's come back to us saying some kind of unique flavor. It's a very simple debt structure. It's a very simple investment, direct equity structure. I've not seen any kind of exotic flavors on top of that.
Oh, okay. Kim, you're on the road a lot. You actually teach young people about entrepreneurship. How meaningful is this as a new tool for that audience?
It's just a wonderful thing. I mean, I think we're focused a lot on the returns for the investor, but I think the return is more than just, the dollar amount at the end of the year. I think we have to think about how many jobs are going to be created, how many people are going to be able to start a business, as well as have some future in the business that they create. We're living in a time where you're not really going to get a job right out of university and plan to retire with that firm 20 years later. So I think that there is some inherent reward, not just in, when is my return going to be received from the investment in terms of that monetary aspect, but if we drill down into why the Jobs Act was created originally, it was all around, the local communities. And because of what got lit up first, which was Title II, the focus has been more on the accredited marketplace and the institutional marketplace. But the reality is that Jobs Act was really created for the communities. And if we look at communities, those are our local pizzerias, our hair salons, our local gyms, places that we want to see thrive because we live there. And so we're not always just looking for that bottom line return. We're looking for something else. So I think talking about the younger people, this is just a real wonderful thing for them to have a future. I mean,
but in addition to younger people, I think Alon would tell you his community also consists of small business owners of all ages. But one of the areas that I know you've spent time and is important to you is women's initiative and women's entrepreneurship. Will it disproportionately be a beneficial tool for women and minorities because it's an alternative means of finance that allows them to raise money from their community?
Absolutely. I think today, if we look at the marketplace for traditional raises, when a woman or a person of different color goes into a room, oftentimes they're sitting across from someone who's not familiar with who and what they represent. And so oftentimes, what we're finding, at least with the rewards and donation-based crowdfunding, is that women are able to be accepted without having to divulge exactly everything about them. You know, they're just really looking at the content of the offering or the project, and they're getting the funding that they need. So I think that this is going to open up a tremendous gateway for that constituent group who actually needs the capital, and we're the majority now, 51%.
So
the
what we
population
framed
of
is
women.
there's a lot of opportunities for entrepreneurs as well as investors, and a lot of those folks will be younger or they're not investment or capital markets professionals. And one of the roles that Sarah's played over the last 4 years, and including to myself, she's the only adult in the room most of the time with her SEC background, and she keeps people in line, and she has a business that is going to help police and do due diligence. I'll let you explain a little bit more in detail. But where I was going with the question is, explain what it does, or what you do, but also the people who are coming across to work with you over the last few years. Are these ne'er-do-wells, or are these people who just don't understand that this is a sale of securities and they need to be educated and taught?
Okay, so what we do is it depends on which type of offering you're talking about, because we have different products for different types of offering. On the whole, though, we are the trust layer in early stage internet capital raises. So we are making sure that the company is what it says it is legal for it to do whatever it is doing. It is internally authorized, whatever it is it's trying to sell. And that it's legitimate. It's a test of legality and legitimacy. But the one thing we don't ever do is say, is this a good company or not? Because that is for the crowd to decide. I would have never invested in Facebook. I think it's the stupidest thing ever. It's for your dumb sister-in-law to have feuds with the other dumb sister-in-law. I've never got Facebook, and so I wouldn't have invested in it. And of course, I would have been absolutely wrong. So let the crowd decide whether it's a good idea or not. But we say, is this company able to do what it's trying to do? Which gets me to the other part of Doug's question, which is, they're not ne'er-do-wells, but if you're an engineer, the idea that you were supposed to have held regular board meetings, or that an LLC can't sell preferred shares, or any of those really boring legal things, they get those wrong all the time. I mean, 90% of all of the companies we've worked with so far have some really major problem with their corporate governance issues, which is fixable, which was certainly not done advertently. But you know, this stuff is difficult. It is difficult to run a company. And so a lot of what we do is just going back and fixing things and making sure it is legal for them to sell what they're supposed to be selling.
Right, and so that's the word to the wise. This is a great new pathway for entrepreneurs to raise money, but this is the sale of securities that has a long history. There are ways of doing it in proper process, and you need to work with investment professionals and lawyers. Brian Korn, who's gracious enough to give us this office, Anthony Zioli, who's also from Chicago, who's on the board of CFPA. These are people who have a role in the capital raising business, and you need to work and consult with them if you want to avail yourselves of any of these new ways of raising money. We don't have that much more time, as I gather, but one of the stories I always found compelling as how the crowd, and I guess Facebook, even though Sarah uses an example of what she wouldn't have invested in, I think there are great examples that have occurred in the last several years that I want you all to be familiar with, of where the crowd got it right and the smart money got it dead wrong. Okay? Opportunities that were presented to the established capital markets and were rejected until the crowd validated them, and ultimately they went on to do wonderful things. So I know, since this is probably near and dear to your heart, but not necessarily on your system, Oculus, Coolest Cooler, Pebble Watch, and some of those stories for everybody.
Yeah, I mean, what is interesting is sometimes when companies start up, there's a perception issue of what is it that you're trying to do and what is it you're trying to accomplish. And sometimes the entrepreneur themselves don't even know what they're trying to do yet, but a large sum of cash can help steer the right smart person in the right direction. And that's something I don't like really saying because I don't believe in that. I believe in fundamental business models. But Pebble Watch was a great example. There was designers from Nike very long time ago that designed a watch in order to create a new kind of tool for people out there in the marketplace. And they did really, really well. And Oculus was another example. It's a virtual reality hardware device that raised a serious amount of funds. And eventually it actually got acquired with $1 billion plus valuation. So yes, that is an example out there in the marketplace. And the crowd got it right, and they were not able to get investment capital early on. Mm-hmm. We've seen on our platform, and I know Kickstarter has as well, VCs approach us to buy our data, and they want to see which projects are doing well and which ones are not, because they're finally recognizing it's a new filter. And it's an exciting filter as well. One of the things I wanted to point out, because Kim alluded to it, is statistically on our platform, 60% of our users are women, and they have a significant correlation to raise more funds than men actually do. And the other interesting part is we have two user groups. One big one is the sub 25, and then this is the one that will surprise people, it's 50 and above. Yeah, a lot. And they're actually the ones that ask us the most to do investment-based crowdfunding. It's really fascinating, but there's this massive resurgence now of people saying, you know what, I want to change my career path, I want to do something else, I want to take my professional experience and apply to a new business concept. And I think we're going to see a lot of people actually from an older generation leverage Title III in specific that most people are not even predicting. Everybody says it's a young person's game. I actually don't believe that to be the case.
Well, thank God for me. Okay.
Well, we're examples of it, right?
Yeah.
Just because I think it's so early in all of the Jobs Act initiatives, Sarah, people always talk about how Title III is capped at $1 million, and how can any startup company really go anywhere with $1 million? The relationship with some of the other exemptions and the possibilities there.
Right. I mean, one of the things to first remember is that when we saw the first Title II raises, most of those were sub-$1 million that we worked on. It was only recently that you started creeping up. So there's still a huge bulk of the Reg D accredited crowdfunding, sub-million. But in the event that you wanted to do a crowdfunding raise, you're certainly going to be able to do a side-by-side with an accredited raise, so long as you do, and to go back to something Doug said, make sure you do it with a lawyer, because you don't want the two offerings to overspread. There are different rules according to what a funding portal and a broker-dealer can do in those two raises, but you can do a Title III raise at the same time, on the same terms as an accredited, unlimited raise. Just don't do it without help.
Okay, and Kim, for the last several years, you've heard the venture community malign this whole new world, and that allowing the crowd into onto the balance sheet and into the capital is going to be problematic for future financings and sales. Have you heard that, and what would your observations or response be to that?
Well, I have observed that, and since Title III hasn't kicked off yet, all I can do is encourage that the next Jobs 2.0, that we can actually get the SPV model put forward, so we can do funds and we can make that cap table look like there's one investor versus 1,000, and I think that would certainly encourage more investment in those offerings.
Do we have a couple more minutes? Okay, one more minute. Okay, so let's close up and end on a positive note, because we are here thankful of Congressman McHenry's efforts, unrelenting efforts, I would point out, and you'll get to hear from him in a moment. What were you most pleased by in the final rules, and just general thoughts on applicability of Title III going forward? All three.
Dumping the requirement for first-time issuers to get an audit. Yeah. Now, you can't overestimate the change, because a review is not a small thing, and if you've been keeping your books in QuickBooks, getting it into any kind of shape to be in generally accepted accounting principles, not a small thing, but it is an example of the SEC being super flexible in that area. And I would add to that the ability to file PDFs on Edgar and not have to Edgarize.
Yeah.
Brilliant.
huge.
Yeah, Sarah's been fighting that big battle for several years now. Okay, Kim?
No, I agree with Sarah. Those are going to
Okay.
be my two.
Alana, anything to add?
I'm just happy to see it passed and then the ability to make changes on it on a new bill, right? So one of the issues is you get something signed and the SEC has to actually get their act together. And that takes a really long time and requires a lot of pressure. And uniquely so, we had industry, members of Congress, everybody kind of keeping their finger on the pulse. And that's a little bit rare to see done for so many years in a row. Yeah.
There is a question in the audience, yes or no?
We'll just do one. and then-
One, Sasha, go.
The people in the 55 plus category, 25 minus that, what percentage of them are interested in participating in equity?
High, so the 55 plus, the 50 plus category, because one of the things I mentioned is, again, we're seeing a lot of users who are 50 and above, they're actually looking to take use of it. They are the overwhelming group that actually wants to do some form of title-free fundraising on our site. They also have statistically the higher likeliness of creating a sustainable business with new jobs, right? So the job creation, people always say it's really large companies that do so, but that's not true. There's a lot of turnover, and small business by themselves is also not really a big sustainable one, but new entrepreneurs, specifically in that 50 and above group, they really want to use equity crowdfunding more so than the younger generation who tend to go towards also debt, to be honest. And the 50 plus wants the equity. Maybe that's actually, I haven't done that analysis, and I'll do it later on today and I'll share it with this group, is who prefers what structure, and I suspect 50 and above are going to actually like the straight equity deal. They are by far the largest demand on our site for equity crowdfunding.
I think I got to cut it off. Sorry, Kim. Thanks everybody for all of your effort over the last 4 years. Genuinely appreciate it.